Hey everyone! Today, we're diving deep into Starbucks' latest financial performance and their new plan to reinvigorate the brand, something they're calling the Back to Starbucks strategy.
If you're an investor, an analyst, or just someone who loves keeping up with financial news and, of course, coffee, this video is for you. Remember, I'm not a financial advisor, so take this as informational and do your own research before making any investment decisions. Now let's get started. Starbucks just wrapped up Q1 of fiscal year 2025, and the results were a bit of a mixed bag. The company reported consolidated net revenues of $9.4 billion, which is basically flat compared to the previous year. On the surface, that doesn't sound too alarming, but the real story is in the comparable store sales. Globally, these declined by 4%, driven by a 6% decrease in transactions. That means fewer people are actually walking into Starbucks stores or ordering online. To offset that, the average ticket price is up by 3%, so those who do show up are spending a bit more per transaction. Despite that silver lining, overall operating income took a hit, and net earnings dropped by around 23.8%. For anyone out there who's more casually interested in Starbucks, here's the bottom line. Fewer people are coming in to buy coffee, but each visit is generating a little more money. Still, net profits are down, and that's something leadership is hoping to fix with their new strategy. What is the Back to Starbucks strategy? So what is Starbucks doing about it? They've rolled out a plan called Back to Starbucks, which has 4 main focus areas. 1. Reintroducing Starbucks. They want to refocus on their coffee expertise. Starbucks wants people to think of them first and foremost as coffee artisans, something that's arguably gotten lost in the explosion of frappuccinos and other trendy beverages. 2. Winning the morning. Starbucks has always dominated the breakfast crowd, but with rising competition, they're looking to streamline operations and recapture those peak early bird hours. 3. Community coffee house. Remember when Starbucks was that third place between home and work? They're trying to bring that back by enhancing the in-store experience, everything from decor to interaction with baristas. 4. Best place to work. Starbucks is emphasizing partner-employee welfare. They believe happy partners lead to happier customers, so they're upping investments in wages, benefits, and training. Then here are the key Q1 financial results. Global comparable store sales, down 4%. North America and US, down 4% as well, with an 8% decline in transactions, but a 4% ticket price increase. International, similar story, a 4% drop in comps. China, in particular, dropped 6%. Despite this, they opened 377 net new stores this quarter, bringing the total to just over 40,500 stores worldwide. The US and China now make up about 61% of the global portfolio. Why the decline? Mostly fewer transactions due, people just aren't stopping by as often. Starbucks hopes that emphasizing quality, reducing menu complexity, and making stores feel more inviting will reverse this trend. The Back to Starbucks strategy isn't just a slogan, it involves real, tangible changes. Refocus on coffee. Expect to see Starbucks push its coffee heritage more aggressively. Marketing campaigns will highlight the art of espresso, the origin of the beans, and the craft behind every cup. Menu simplification. They're cutting about 30% of beverage and food items by the end of fiscal year 2025. This should make life easier for baristas and hopefully speed up service. In-store enhancements. Get ready for the return of condiment bars, ceramic mugs, and maybe even those handwritten notes on your cups. Little personal touches. Plus, free refills for non-rewards customers are coming back, which could draw in more casual visitors. Mobile ordering improvements. They're exploring scheduling time slots for mobile orders to avoid the dreaded backlog. And they want promise times under 15 minutes so you're not waiting around for your latte. Digital menu boards. You'll be seeing more high-tech displays rolling out across company-owned US stores in the next 18 months, making it easier to see what's available and what's new. Store throughput and wait times. One of the biggest challenges Starbucks faces is managing both in-store lines and mobile orders simultaneously. If you've ever been stuck behind a massive mobile order queue, you know the struggle. Their solution? Segmenting stores. They're classifying stores by transaction volume and only installing top-tier espresso equipment, their siren machines, in the highest volume spots. Syncing orders.
Starbucks is piloting a new in-store prioritization algorithm that figures out when and how to make each drink, so baristas can keep lines moving. If it all works, you'll see faster service and shorter wait times. Win-win. Balancing investments and cost efficiencies. You might be wondering how Starbucks can afford all these improvements.
The company says they're reallocating resources. Instead of using deep discounts to lure in customers, they're shifting that money into better marketing and partner wages.
Meanwhile, they're finding cost savings through more efficient scheduling and supply chain optimizations. Think 150 basis points in Q1 alone. By cutting unnecessary costs, Starbucks hopes they can continue to invest in store remodels, new equipment, and, importantly, their workforce. Unit growth, doubling down on the US. Despite the dip in comparable sales, Starbucks still sees the US market as a big opportunity. They're talking about doubling their store count in the US over time. That includes new builds in areas like Texas and the Southeast, plus experiments with smaller format stores that can fit into more locations. They're also actively reviewing their existing portfolio to decide which stores should be renovated, which might be closed, and where new ones should pop up. In short, Starbucks believes they still have a lot of room to grow on home turf. Looking ahead, the rest of fiscal year 2025 Q2 might be rough. They expect EPS, earnings per share, to dip further, in part due to coffee price fluctuations and some organizational restructuring costs. Better in the back half. After Q2, they see sequential and year-over-year improvements as their efficiency efforts and brand revamp start paying off. Long-term focus. The ultimate goal is to streamline operations, improve margins, and keep customers coming back for more than just their daily caffeine fix. It's also worth noting that Starbucks has put some long-term investments in place, a new mission statement to emphasize coffee quality and community, plus a coffeehouse code of conduct to keep partners focused on excellent customer service. They're even doubling paid parental leave for many U.S. retail employees starting in March 2025. All of these moves speak to a company trying to regain its footing and revitalize its culture from the inside out. So is Starbucks on the right track? Only time will tell. The Back to Starbucks strategy sounds promising on paper. A renewed focus on coffee quality, streamlined operations, and happier employees. But we'll need a few more quarters to see if these changes can truly reverse declining transactions and boost overall profitability. If you're an investor or a Starbucks fan, keep an eye on those comparable store sales numbers in the next couple of quarters. The big questions are, will a simpler menu speed up service? Will focusing on coffee authenticity resonate with customers? And will Starbucks' investments in partner satisfaction lead to better customer experiences and ultimately higher sales? Thanks for joining me for this breakdown. If you found this video helpful, make sure to hit that like button and subscribe for more financial and business updates. I'll catch you in the next one.
And remember, this isn't financial advice. Always do your own research.